Hi, we just talked about, on the last video, unmodified opinions. So you do your audit, everything's fine, they're fairly presented, here are the paragraphs that go in there. But not everything's always fairly presented, so what do you do then? Well, that's what we're going to talk about now. Alright, well before I go here, I just want to point out here, we're going to talk about two reasons you might depart from GAAP. Alright? Two reasons you might have an unmodified report. Alright, so in other words, why would we have something other than just a standard report? Well, one could be a departure from GAAP, right? You find, oh, this isn't actually fairly presented, right? So departure from GAAP. So what do you do then? Or you could have something we call a scope limitation. It's not necessarily a departure from GAAP. A scope limitation means you weren't able to audit that part of the financial statements, right? So some component is like missing, all right? So either there's a known departure from GAAP, or you don't know, maybe not, if there's a scope limitation, right? So we're going to talk about these two scenarios, and then in the next video we'll talk about group financial statements. All right, so first scenario, so best case scenario is you have an unmodified opinion. These financial statements are fairly presented in accordance with GAAP. Oh wait, maybe sometimes they're not in accordance with GAAP. So here's a little flow chart that tells you what you can do. All right, so let's suppose you have a departure from GAAP. You go do your audit and you find something like, oh my goodness, this lease is supposed to be an operating lease, and you have it as a capital lease or something like that, you know, or vice versa, whatever. You find something weird, or wrong, I guess I should say. You find something that's a departure from GAAP. Let me just say that. Okay, so then you go, okay, well, is this material? Right? So if their accounts receivable are misstated by $10,000 and it's Walmart, that's not material. Nobody cares. So you just go right ahead and issue that unmodified opinion. But if you have a departure from GAAP that is material, now you go to the next step and you ask yourself if it's pervasive or not. All right, so pervasive, what we mean by pervasive is it affects multiple accounts. All right, so if it just affects one thing that can kind of be cordoned off by itself, like the lease thing. You've misclassified this lease. All right, and that's it. That's all it affects, right? You have a contingent liability that you believe, as the auditor, should be in the notes, and they believe not. It's material, right? So one thing that you can keep separate that is not going to affect multiple accounts, right? So if it's not pervasive, if it's just like, oh, it's just this one lease, then you can do what's called a qualified opinion, right? It's like you'll talk about that thing, right? But if it's pervasive, in other words, it's affecting multiple, let's say it's something wrong with inventory. Well, inventory is not just inventory. It's going to affect cost of goods sold and net income, right? It's going to be a big problem. So if you have multiple accounts being affected, you have to go with an adverse opinion, which means these financial statements, they are not fairly presented. They are materially misstated, right? And you're putting that out there for the world. Now, of course, they won't get out to the world because nobody wants materially misstated financial statements, but that's called an adverse opinion. So the decision tree is there a misstatement? Or a departure, is there a misstatement? Is it material? No. Unmodified. If it is material, now you have to go, okay, can I kind of tell people, like, this one little thing off to the side is what's misstated. If you can put it off to the side, then you can go ahead with a modified opinion. If it's it's messed up a bunch, then that's what we call an adverse opinion. All right, so what do you do when there is a material but not pervasive? Well, you have the same thing, right? The report of the independent auditors, and this was what we did, and this is the management's responsibility, this is auditor's responsibility, here's our opinion, right? So down in the opinion paragraph, what you do is before the opinion paragraph, where you say, these financial statements are fairly presented in all material respects. Before you say that, you say, this happened. They have capitalized this expense. We believe GAAP calls for it to be expensed in this period. But, whatever you think, whatever the deal is, you describe that, right? Because it's a thing you can break out and it's one little thing. It's not pervasive. So you make a little paragraph before the opinion. They've got this thing going on. Then, in your opinion paragraph, the difference is, instead of saying, in our opinion, these financial statements are fairly presented in all material respects, you put this little sentence, except for the matter discussed in the previous paragraph. So then that would look like this, right? So it would say, as discussed in note 16, right? And you just go on and you explain what happened. Here we go. The amount for uncollectible so in this example, they're talking about an allowance for doubtful accounts, and they think it should be this much, and the management thinks it should be some other amount. So the auditors say, here's what we think. This one little account has a problem. And then here's that, except for the effects of the matter described, they're fairly presented, right? So that's a qualified opinion. All right, qualified opinion. All right, so what about an adverse opinion? Well, that means it's not just one little thing you can separate out. There are multiple accounts that are misstated, and the misstatements are material. All right, so you have to say that, right? Well, we did this audit, so it's all the same, right? Report of the independent auditor. Here's what we did. Here's management's responsibility. Here's auditor's responsibility. Then this paragraph. Here's the issue. Then your opinion is changed to financial statements do not present fairly. And if you look at that, you will see, as discussed in this note, this provision, blah, blah, changes, which should be reflected in income statement, shareholders' equity, cash flow. So it's really messing up a lot of stuff. And then, of course, here's the opinion paragraph now. And you can see in red, do not present fairly the financial position. So that's an adverse opinion. All right, so that's what happens when there's a departure from GAAP. All right, so you can have an unmodified opinion. Everything's fine here. Let's go on, unmodified. Or you have a departure from GAAP, in which case you'll have either this qualified opinion or an adverse opinion. But let's suppose the problem isn't a departure from GAAP. Let's suppose we don't know, right? That's what's called a scope limitation, okay? So a scope limitation means there was something you couldn't examine in the course of your audit. They had several warehouses and they didn't let you go to one of them. They just said, no, we're in the middle of doing some stuff there and it's too dangerous and we don't want you to go to that warehouse. I don't know. Something was in another country. I don't know. COVID-19 virus. They told you not to come in, that this warehouse was infected. I could think of a lot of reasons why they might not let you look at something that kind of could be legit. But a lot of times, it's not. They're just trying to hide something from you. But at any rate, I mean, sometimes they called you too late. I mean, think about that. They already did their inventory. You are supposed to observe at least some of the physical count of the inventory of a client if inventory is material. All right. So maybe there was just something you couldn't do because they hired you late. I'm not saying anything nefarious at all, but that's a scope limitation. You didn't get to do some part of your audit that under GAS, Generally Accepted Audit Standards, say you should have done. All right, so you didn't get to do that inventory. You didn't get to go to that warehouse. You didn't get to send confirmation letters. That's a story I heard one time. Somebody was auditing a funeral home, and the funeral home asked them to please not send confirmation letters. They wouldn't give them their customers' addresses because they didn't want them sending like letters to the grieving widows. So they didn't get to do confirmations. So, that's still a scope limitation, right? Whether it's legit or not, whether they really have coronavirus or not, it's still a scope limitation. That's not what we're saying, that it's legit or not legit. We're just saying there's some part of the audit we didn't get to do. That's a scope limitation. So when you have a scope limitation, you have a decision to make. So here's a decision tree, right? So the first thing you ask yourself, well, they hired us after they took inventory. So you go, is it material? Well, this is Walmart. Inventory is material. That's a big deal, right? Or, well, this is a law firm and they don't really have much inventory. Sometimes they sell some of this software to people, but they don't really have inventory. It's not material, right? So maybe it didn't matter that you couldn't go to one warehouse. It's Walmart. We went to every warehouse except one. I mean, that would be not material, right? So if that scope limitation is not material, then it doesn't matter. You've got an unmodified opinion, right? But what if it's material? We couldn't observe their this one warehouse, right? But it's a material amount, right? So now what? Well, is there some alternative procedures available? Why, yes, there are. I can get the purchase orders and the receiving reports, and I can trace those, and I can follow the sale of that same item. Maybe it's something that has a serial number, right? It's a car lot, and you could find when they purchased the car, you can find when they sold the car, you can find when the car was paid for and they received the cash for it. I mean, you can look at the car title trail. If you can put together an inventory, that would be okay, right? As the auditor, if you know. All right. So it's something else you can do. If there is, right, then fine, do that. Right? Fine, go do that. You couldn't send confirmations because it's a funeral home. Oh, but everybody paid for it later, so they must have been receivables at the time. All right, so you check that out. All right. Now, let's suppose you couldn't do that part of the audit, whatever it was, send confirmations, observe inventory, whatever it was. That tends to be two of the main ones, right? So it is material. There's no alternative procedure. Now you have to go, is this pervasive, right? And again, that same criteria applies. Is it affecting multiple accounts, or is it just affecting one account? Right, something we can take off. We can say, do that. They wouldn't let me talk to the attorneys. I couldn't send an attorney letter. That's a scope limitation. I didn't get to do my attorney letter. So I don't know what the likelihood of this lawsuit being a contingent liability is. I just don't know, right? So is it material? Well, the whole lawsuit itself is only for $1 million. So even if they lost that, it's $1 million. Well, it is material. Say $1 million is material. It's material. But that's just one thing, right? It's just going to be a $1 million expense in a future period, we can look at that. And it should be in the notes, but it's not. So I can explain that. So I can explain that one thing and do a qualified opinion. But let's suppose it is pervasive, right? I didn't get to observe inventory. I couldn't do alternate procedures. So now inventory, I don't know if inventory is right. It's material. I don't know if ending inventory is right. I don't know if beginning inventory is right. I don't know if cost of goods sold is right. All right, so you can see this is like an issue, and it could, if it's raw materials inventory, it could follow you through work in process and finished goods inventory, cost of goods sold, net income. So yeah, so if it's pervasive, well, you don't know, right? I don't know. Could be fine. I don't know. I didn't get to count the inventory. Maybe they counted it perfectly, right? But I don't know, because I don't have a way to check. So if it's pervasive, I just need to do what's called a disclaimer. And then I just say, I don't know. So an issue with scope limitations is they can be circumstance imposed or client imposed. So that's one little twist on these scope limitations. So the situation is beyond my control. I couldn't observe the inventory because they hired me too late, or it was in another country and something that I needed to look at was in some other country, and then there was no more flights and nobody was allowed to go to that country. It happens, right? So circumstance imposed or client imposed. So if your client is doing things where they say, no, you can't talk to my attorney, no, you can't go in that warehouse, no, the client's doing it, you have to think that's probably something that's a problem. They're not wanting you to look at on purpose. So you'd have to probably just do a disclaimer on that. All right. So what does it look like when you have a non-pervasive scope limitation? I was not able to get the letter back from the attorney in time, so I couldn't hold this up any longer. So what do I do? Oh, it's just sort of the same thing like if there's a departure from GAAP. You have your same report, you add that paragraph, here's my scope limitation, and then in the opinion paragraph you put that except for, right? So there you go. Did not make account of their physical inventory and we were unable to observe. Do not permit the application of other procedures except for the effects of the matter described above. We believe it's the financial statements are fairly presented. What about a disclaimer? Well, a disclaimer is that thing that occurs when it's pervasive. They're material and pervasive, and typically client imposed. The client refused to let us do something, right? So you add that paragraph, and it looks like that. So we were engaged to audit, but because of the matter explained here, in this case it's the same thing, they did not make account of their inventory. We couldn't get sufficient inventory, so we were hired to do the audit, right? But we couldn't do it because of this. So we don't express any opinion on these financial statements. That's a disclaimer. We have no opinion. You're not saying they're good. You're not saying they're bad. All right. So you start with an unmodified opinion. Then you can have either a departure from GAAP or a scope limitation. And depending on are they pervasive or not, you're going to have either, depending on if it's departure from GAAP or scope, you could have an adverse opinion if it's pervasive departure from GAAP, or you can have a disclaimer if it's a pervasive scope limitation, right? Adverse means these financial statements are bad. Disclaimer means I don't know what anything. they could be good, they could be bad. I wasn't able to look at something important, so I can't tell you. When we come back, we will talk about group financial statements.